The market, a disaster unfolding right in front of our eyes. The S&P 500 is down over 20%, the NASDAQ almost 30%, and speculative stocks like Pelton over 90%. All equities and even bonds seem to be in shambles. On top of these problems, inflation continues to rage while everyone is left wondering what is next. Luckily, as bad as things are, thankfully the pain and suffering is contained within the stock market, with layoffs remaining rare and the unemployment rate holding steady at near record lows. However, with tech companies blowing up and major indexes holding on for dear life, many are beginning to wonder, how bad is this going to be? Will this be our 20s depression? Is this the big one? Everyone has talked about the super bubble imploding in the past. The years that followed the financial crises in 2008 created a crowd of people worried about an obvious problem that was slowly developing over time. You see, when the Federal Reserve stepped in to lower rates and print money, it caused a unique economic situation. With rates at such low levels and the Fed interfering with markets on such a large scale, the inevitable threat of inflation became a bigger and bigger problem. But somehow, for more than a decade following unprecedented money printing and Fed assistance, we saw nothing. We were living in the golden age, easy money with nearly zero inflation. This era saw thousands of companies grow to sky-high market caps on mostly zero profits. Hundreds of other stimuli increased speculation, leverage, and pure greed on Wall Street. The market soon resembled a gambling parlor, but everyone was winning. The post-recession years resulted in one of the best bull runs in the history of modern economics. For every crisis, there was the Federal Reserve to step in and push up stocks. But this party was almost stopped in March of 2020. After an unexpected worldwide pandemic, this cloud hanging over the economy finally developed into a storm. The Fed saved the market at the expense of record money printing, the bazooka as it was called, an injection of cash never before seen in world history. The S&P 500 went from minus 33% and recovered in less than 4 months, but this injection of economic steroids was too much. Finally, after years of abuse, the economy was showing signs of pain. Inflation became a problem, and with it, the Fed was left with the painful choice that many in years past claimed would end in disaster. Right now, it's in a situation that essentially leaves it only two options, both bad and both unavoidable. On one hand, they need to contain inflation, which means raising the interest rate, but doing so inflicts serious damage to the economy. We're already seeing that despite only 2 tiny raises. On the other hand, they could do nothing and let the stock market flourish, but you would get even higher inflation, something that today is unacceptable following massive price increases. Since 2019, gas prices have gone up 53%, houses have gone up 36%, food, rent, cars, and most other items are no exception. But the question remains, how does this end? Is this the big one we mentioned earlier? According to Peter Schiff, this is only the start. He claims that because of the Fed behavior of the last 10 years, this mega bubble that is bursting as we speak will be the largest economic meltdown in history. An opinion that isn't taken very seriously by most, but neither was his previous prediction that inflation would be as severe as it has become. Turns out Peter was right on many of his so-called wild takes. Take a listen to his unique analysis.
So the year-over-year CPI is now up 8.3%, and the core is up 6.2%. It was 6.5% in March. But this is still a big number, and there is no indication anywhere that the Fed has made any progress in its inflation fight. In fact, it hasn't even really begun its inflation fight. Even though we have a 50 basis point rate hike under the Fed's belt, we're at 75 basis points basically to 1%. In an 8% inflation world, even if that's a fantasy world, the rate is too low. The Fed is further and further behind the curve by dragging its feet. And look at the balance sheet. The balance sheet has really not even begun to shrink. In fact, last week, I think it ticked up a notch. Not very much, but it didn't go down. We have a long way to go to actually withdrawing all the liquidity that has caused all the inflation. The inflation was the expansion of the money supply. Now they need to contract that money supply, but they're not even coming close to doing that. They're talking about starting it, but they haven't actually done it. That's why I keep saying that the Fed is just pretending that it's going to fight inflation. Because if it really wanted to fight it, it would be doing it. It wouldn't be talking, it would be acting. Rates would already be much higher. They wouldn't be talking about these future rate hikes. They would raise rates right now in the present. They wouldn't be talking about shrinking their balance sheet in the future. It would be shrinking right now. The reason they're not fighting inflation is because they can't, but they can't admit that, so they have to keep pretending they're going to fight it. And for now, the markets either believe the Fed or they're pretending to believe the Fed.
Now, who knows if Peter will be right? What we do know is that bear markets typically play out slowly with massive declines followed by false rally after false rally. It's easy for us to think about a recession from the past as a quick one-time event that unfolds overnight, but in reality, they sometimes take years to fully grasp. Even in the Great Recession, you can see this behavior unfold. For example, the S&P 500 peaked in October of 2007, before falling 17% over the course of 6 months. However, in March of 2008, it looked like the market had stabilized. The S&P went on to recover nearly 10% of its losses, and I'm sure many at the time were predicting the end of a bad correction. But what followed this second peak on May 12, 2008 was a disaster. Another 10% fall that bottoms in July, then goes sideways till September, followed by one of the worst cliff dives in market history. By the end of March 2nd, 2009, the S&P 500 had declined over 56%. Now think about that for a second. The market began its drop in October of 2007 and didn't bottom out until March of 2009. That's almost a year and a half of decline, with multiple periods where it looked like the market was poised for a comeback. Now if we look at our current situation today, it could very well just be the beginning of an economic disaster, but we won't know until it plays out, because historically there have been plenty of false rallies to throw off our belief that we are undergoing a depression or massive recession. That's just the nature of crashes. Whatever the case may be, times are getting rough. Inflation doesn't seem to be going away, yet the economy is looking shaky, a situation that is moving towards stagflation, a double-edged sword that plagued this nation in the 70s and 80s. Trading in this environment is risky and psychologically taxing. Figuring out what is the rally and what is the false rally is a task that few can conquer. I would love to hear what you guys think about the future in the comments below. As always, thank you guys for watching, and make sure you hit that like and subscribe button if you enjoyed it.